The S&P 500 has almost recovered all its losses since Liberation Day. So, is this the V-shaped recovery all of us have been waiting for? Or will we still see more downside going forward? Let's find out in this video. Now, everyone knows that this whole crash and even the recovery has been largely caused by one man. 1 minute, he's slapping tariffs on everyone, including the poor penguins. The next minute, he's postponing the tariffs by 90 days. Then he goes and hikes China's tariffs to 245%. But then blinks first by saying that it will be coming down substantially. After that, he says that he's working on the deal with China. But China says that they haven't even spoken, to which Trump insisted China did call, but China denied it again. Meanwhile, back in the US, Trump says that he wants to fire Powell for not cutting rates fast enough, only to turn around and say that he has no intention of firing him. I don't know about you, but he's probably very good at flipping prata. But where will the markets go from here? Obviously, I have no way to tell where the market will go in the short term. But I found 3 signals which seem to suggest that the market is bullish over the short term, at least for now. The first sign actually came from the White House itself, believe it or not, where they hinted that they are considering to lower China's tariffs from the current level of 145% to 50% and 65%. This could certainly be possible given that Trump has repeatedly insisted that he's in talks with China, while Treasury Secretary Bessent has also come out to emphasize that America first doesn't mean America alone. At the same time, China has also mentioned that they are open to talks, while also quietly rolling back some retaliatory tariffs. This indicates that both sides are actually willing to talk, and if possible, avoid escalating this any further. The second signal came from the fear indicator itself, or better known as WIX. So when the market was crashing on April 8, the WIX spiked all the way up to 50. Historically, there have been only a few times where the WIX spiked to this high. According to the Treasury Secretary Bessent, who was a former hedge fund manager, he mentioned that if we measure uncertainty by the WIX, I think that the WIX, I don't want to make market calls, but I think that the WIX spiked and has likely peaked. Now, even though he said that he doesn't want to make market calls, he went and made a market call anyway. If the WIX has peaked, then the market likely bottomed, which means it could be a time to buy. History seems to agree with this too, because whenever the WIX peaks, the market tends to rebound, and the further out you go, the better the odds. In fact, by the 1-year mark after the WIX spiked, the market has only seen green. Finally, the third signal came from this thing called Swig Breath Trust, which the S&P 500 triggered very recently on April 24. I won't even pretend to know what this indicator is, because the calculation is quite cheap. But essentially, it is an indicator that detects stocks going from oversold to overbought within a very short time frame. When that happens, there's a very high chance that the market ends up in the green, whether it's 1 week later, 2 weeks later, all the way to 1 year later. These days, the market moves fast. One moment is calm, the next is reacting to news or surprise events. That's where Momo Singapore comes in useful, giving you the tools you need to stay informed and invest with confidence. First, the economic calendar allows you to stay updated on upcoming market moving events like CPI data, earnings reports, and rates announcements. Then, with Momo's 24-hour news coverage, you are always in the loop, which is especially free to their clients. Whether it's overnight headlines or midday surprises, Momo helps you catch the key updates as they happen. Besides that, the live feature in Momo's community section is a live streaming platform where analysts and like-minded investors like you and I can come together to share market views, discuss investment strategies, and engage one another in real time. Otherwise, if you are looking to diversify your portfolio, great news! Momo supports US, Singapore, Hong Kong, Japan, and China shares, plus options, funds, and even crypto. As a recent hot topic, US Treasury bonds are also one of the investments that the market is focusing on. You can buy bonds directly on Momo Singapore. Just head over to the Discover tab, tap on Wealth, bonds, and here you'll find a variety of bonds that you can invest in. New users who sign up to Momo Singapore, you'll get to earn up to 820 SGD worth of welcome rewards when you fulfill the terms and conditions. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. However, despite these bullish signals, I guess it's still pretty hard to imagine how the market could continue going up from here, because obviously, the trade war has only just started. And with Trump's constant flip-flopping, a resolution doesn't seem to be likely anytime soon. For example, Trump has hinted that he might continue on with the tariffs despite the 90-day pause. There's little progress between US and Japan trade negotiations, and even if the US and China wants to negotiate, the deal would only come 2 to 3 years later. So, in order to better understand where the market might go during this period of uncertainty, we can look back at 2018, when Trump started his first trade war, because while history doesn't repeat itself, it often rhymes. So, back in 2018, the whole trade war started on January 22, and the stock market dropped by 10% in just 14 days. After that, the market tried to recover, but quickly dropped again when Trump slapped tariffs on steel and aluminium. However, what's interesting is that in April, when China finally retaliated with their own tariffs and Trump threatened to retaliate the retaliation, it doesn't seem to affect the stock market anymore. Instead, the markets continued to go up, and even when there was further escalation in June and July, the market kept going up and up until it even surpassed the previous high. It's only when Trump threatened to impose tariffs on all imports from China that the S&P 500 started to come back down. But then on December 1st, when the US and China finally announced a truce, the market crashed back down. Why? It wasn't because of the trade war. Instead, it was because a yield curve inversion happened, which suggests that a recession might be on the horizon. So that caused investors to get worried and the markets started selling down. Then later on, the Fed also spoke the market by saying that they will continue hiking rates in 2019, despite the slowdown in the economy. However, out of nowhere, the S&P 500 bottomed soon after and kept going up from there despite the trade war still going on. So, based on this, we can learn a few things. First, if the markets already expect something like a trade war, escalation or retaliation, then that news is likely priced in already and won't move markets much. So, don't be surprised if US or China imposes more tariffs on one another and the markets barely reacts, because it's not that investors don't care, but rather it's because they saw it coming already. This means what will cause the market to go down now isn't so much about the trade war anymore. Instead, it is something that none of us expects, like the Fed suddenly raising rates all over again, or the inflation suddenly shooting back up, or the economy suddenly slowing down, or a sign that a stagflation could happen, and so on. Because all this likely hasn't been priced in yet. In fact, even the perma bulls Tom Lee has also said this a few days ago.
Yeah, I think it's going to be hard to match that level of fear again. So I think we're probably past peak uncertainty. I mean, even with this Fed controversy, but I don't know if we're past maximum pain. You know, I think that there's still risk that the economic consequences are going to cause markets to be hesitant, but it's going to be hard to match that fear again. So I think a structural low did take place.
Basically, he said that even though VIX has come back down and we are past peak uncertainty, there's still a lot of things that can cause more pain to the markets, such as a slowdown in the economy. The second thing that the 2018 trade war tells us is that it's never clear where the markets will go in the short term, because there are so many moving parts that can affect the stock markets. For all we know, maybe the bottom has already happened, or maybe next month the markets will drop by another 20%. Who knows? That's why you should never try to time the market, but instead stick to a strategy where you consistently buy in no matter what. As Nick Collis, a veteran equity researcher, once said, getting out is easy, but getting back in is hard. I've seen every major market low since the 1980s, and none of them were even remotely obvious. So if that's the case, what can we look out for to determine where the market could be heading? It's definitely not Warren Buffett, who seemingly has not bought anything yet. Instead, the thing that we can look at is companies' earnings. That's because what ultimately drives the performance of the stock markets isn't some economic data, but rather the company's earnings. For example, back in 2018, what you will notice is that the forward earnings per share represented by this dark blue line here has been rather resilient and has kept going up despite the trade wars. Then, once the uncertainty cleared up, the market eventually went back up to match its true value. Similarly, if prices run up too far ahead of the forward earnings per share, the market tends to correct eventually, just like what we saw in 2021 and again now. So far, we are still pretty early in the earnings season, so we don't have much data on companies' earnings just yet. But among those who have already announced earnings, almost half of them have issued negative earnings per share guidance, while the other half have issued positive guidance. But perhaps the more influential companies that can either save the markets or break it would be the Magnificent 7 stocks, since they take up almost 25% of the S&P 500. So far, only Google and Tesla have announced their earnings. Google beat estimates while Tesla missed estimates, but both went up anyway, because Tesla. So if the rest of the Mag 7 stocks reported good earnings, we could probably expect them to help lift up the market. But if they don't do well, let's just say we can expect another fun time in the market. In fact, even if they reported bad earnings, many of them have pretty attractive valuations right now. According to my estimates, Nvidia has a fair value of $130, which suggests that there's still a potential upside of 15%. Amazon is at its fair value right now. Same for Meta, both of which are incredible companies that still have a lot of potential growth in them. Heck, even though Microsoft is quite overvalued now, they are incredibly resilient against recession. So if they ever sell down, I will be more than happy to scoop them out at cheaper prices. Whatever the case, it will be pretty interesting to see where the market will grow from here. But as always, stay sharp, stay invested, and I will catch you in the next one. Peace!